we're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
This effort, and China has big plans for this. They intend to seed their digital yuan into the global environment by giving it away to visitors at next winter's Olympics. When they arrive at the airport, they're going to get yuan digital wallets. They're going to receive digital yuan. They're going to use it throughout their visits to Beijing, and then they're going to take it back to their home countries. They see this as a huge advantage. Why? Because who controls the underlying protocols, who controls the underlying standards of the future of money will control the future of money.
These skills by asking you to think about the magic 7. Okay? Most of you will know that 7 is quite a number in all sorts of themes, religions, and I'm sure that you can compress numbers as well. So, if we think about 2014, all right, I'm just giving you 2014, you drop the 0, 14, 2 times 7. Okay, that's just by way of example, and we're going to carry on. So 2014 will be a milestone and hopefully a magic year in many respects. It will mark the 100th anniversary of the First World War back in 1914. It will mark the 70th anniversary, drop the 0, 7, of the Bretton Woods Conference that actually gave birth to the IMF. And it will be the 25th anniversary of the fall of the Berlin Wall. 25th. Okay. It will also mark the 7th anniversary of the financial market jitters that quickly turned into the greatest global economic calamity since the Great Depression. The crisis still lingers. Yet, optimism is in the air. We've left the deep freeze behind us, and the horizon looks just a bit brighter. So my hope and my wish for 2014 is that after those 7 miserable years, weak and fragile, we have 7 strong years. Now, I don't know whether the G7 will have anything to do with it, or whether it will be the G20. I certainly hope that the IMF will have something to do with it.
Welcome to the Crypto Teacher. And guys, I come back with that video just to make you think. We had Coinbase launch today, and they did not surprise us, guys. What did they do? They ran it up, and then, of course, we had selling pressure. So we know what? The Ponzi scheme doesn't end. We know Bitcoin at over 60,000 is a Ponzi scheme. We had Bernie Madoff pass today, Ponzi scheme. On the day of his passing, how does CNBC reward him? By playing the old documentary. But what they're not going to show you is that JP Morgan knew what he was doing all along. You know I've been over banks, guys. Goldman Sachs steals the Malaysian pensions. We know time and time again banks steal money, and guess what? No one goes to prison because we know what? They're the biggest gun-running, money-laundering, drug-dealing son of a guns. And then lastly, guys, we have Jerome Powell ready to taper that balance sheet. Because we know he can raise rates on a $7 trillion balance sheet. The stock market will collapse. So what are they going to do? They're going to allow inflation to run wild. Because what do? They cause a problem. Wait for the reaction and run in with the solution. And what is that solution? That's right, cryptos, drones, robots, AI. And we have all these people out of work relying on the government. So they're going to run to their government pleading, and they're going to give them what they want. That programmable money. We know nothing is free. There's always a price to pay, especially when you're dealing with the Fed. Because we know when it comes to the New World Order, everything is planned out. Y'all have a wonderful day.
Worried about debt and deficits. The debt is pretty high, 27 trillion or so, and the annual deficit is now about 2.5 to 3 trillion or so. Is that a concern to the Fed in terms of impacting inflation?
So yes, in the over time and in the longer run, the U.S. federal budget is on an unsustainable path, meaning simply that the debt is growing meaningfully faster than the economy, and that's by definition unsustainable over time. It's a different thing to say that the current level of the debt is unsustainable. It's not. The current level of the debt is very sustainable, and there's no question of our ability to service and issue that debt for the foreseeable future. I would also say, though, that as a nation, we will have to eventually get back to a sustainable path. That is something that is best done in very good times, when the economy is at full employment and when taxes are rolling in. This is not the time to prioritize that concern, but it is nonetheless an important concern that I believe we will ultimately have to return to, again, when the economy is strong.
Now, you have previously said, I just want to ask you if you feel the same way now, that currently you do not expect the Federal Reserve to increase interest rates before the end of 2022. Is that a correct view of what you've said?
So here's what we've said. We've said that we would expect to keep interest rates where they are today until three particular outcomes are achieved in the economy. The first is that the recovery in the labor market is effectively complete. The second is that inflation has reached 2% and really reached it, not just sort of tapped the base, as I like to say, but has reached it sustainably. And the third thing is that inflation is on track to run moderately above 2% for some time. Those are the tests. So we are really focused on the progress of the economy toward those goals and not on a particular time frame. When we get those three boxes checked, that's when we'll consider raising interest rates, and that's when we'll raise interest rates. Until then, we won't. So what you're referring to, I think, is we all write down these projections every quarter in the March, June, September, and December FOMC meetings, write down individual projections, and we submit those, we tabulate them and publish them. And most members of the committee did not see raising interest rates until 2024, but that isn't a committee forecast. It isn't something we vote on or act on as a group. It really is just our own assessment. And so I think there's a tendency of markets to focus too much on what we call the dot plot, the summary of economic projections. And I would focus more on the outcomes that we've described and the best assessment we can make of our progress toward achieving those.
Okay, but based on what you know today, you would not expect to increase interest rates before 2022, or you're just not saying that yet?
Well, before 2022, that would be this year. I think that would be highly unlikely. I don't talk about particular date. I don't think there's any use in that. So, but it really is outcome based.
Okay. Well, let me ask you, last time the Fed did increase interest rates, it did so by a little bit, and then it started shrinking its balance sheet a bit. Do you have any view on whether that's the right way to proceed when you begin to increase interest rates? Should you increase interest rates and then shrink the balance sheet later, or should you begin to shrink the balance sheet and then increase interest rates? Do you have any view on whether one policy or the other is better?
So what we did after the global financial crisis was first we were buying assets, and then we gradually slowed the pace at which we were buying treasuries and mortgage-backed securities, and then we held the balance sheet constant for a while. After that, we started raising interest rates. We raised them gradually, and at some point we held the balance sheet constant. So we don't sell bonds into the market, and we either, when they mature, we either reinvestment or that we allow them to run off. So that's what we did last time. I think if you look at the sense of our guidance, it is that we will reach the time at which we will taper asset purchases when we've made substantial further progress toward our goals from last December when we announced that guidance. And that would in all likelihood be well before the time we consider raising interest rates. we haven't, voted on that order, but that is the sense of the guidance, is that it would work in that way.
Of not selling into the market the bonds you already have or other securities, but just let them mature, and then that's the way you'd shrink your balance sheet. Is that right?
These are questions which lie ahead of us, but essentially, though, I would say it this way: the first thing we do is we say that we will gradually reduce the pace of our purchases, and then when the purchases go to zero, the size of the balance sheet is constant, and when bonds mature, you reinvest them. Now, then another step, and we took this late in the day, the last cycle, was to allow bonds to start to run off. And we haven't decided whether to do that or not. We didn't then, and I don't think we now would ever actually sell bonds into the marketplace.